So good morning, everyone. Before I begin, I just want to thank FSM for giving us the opportunity to present this session entitled Navigating the Peaks, the Global Case for Equities. So how we'll structure this presentation is I'll go through some of the macro bit as well and set the stage for equities. And then I'll invite my colleague Daryl to kind of share some of our key strategies as well. So what's in store for us over the next 15 minutes or so? What we would do is really address some of the headlines that you're hearing, right? Trump is coming in 2 days. What's going to happen? I was at our booth over there, and I've gotten so many questions on that as well. So we will address some of the concerns that some of you in this room might have. And then what we're going to do is that we're going to cut through all the noise, and we're going to look, how is the US economy? What is the state? It's still positive, long story short. And then we'll see about US equities as well. And then we'll end off with, what about outside of US? Is it just a US-centric opportunity? Are there more opportunities for all of you in this room? So let me just introduce this concept called negativity bias. It's a cognitive concept, right? We consume so much media, social media, whatever we read, we listen, what we hear from our friends. And what really triggers us, all the negative emotions, concern, worry, anger. It's always the bad news. When you read something, it doesn't really, you don't feel happy when you look at a headline, but all the negative news just hits you a lot stronger. So what we're trying to do right here is what we tell our children and what our parents told us, is let's confront our fears. And that's what we're going to do now as well. So imagine right now we are operating in an environment of fog, as you can see on the screen here. And obviously, there's so many uncertainties that could happen in 2025, but over here, we've listed 5 of the ones that we're very concerned by. And what we've done is that we've broken it into an acronym that all of you remember, IFBUT, if and but. So let's start with the first one, inflation. Now, inflation is one of that terminology, right? When you hear it, oh no, it gives you that sort of worry, because now you're starting to wonder, if I go to the NTUC right now, is that packet of rice going to be a lot more expensive tomorrow compared to today? That gives you that worry, right? And what I'm here to tell you is that when you hear all these things about inflation in the developed market, let's debunk it right now. What you can see in front of you is the 3 largest economies and where the inflation was and where it's going to be for the rest of 2025. And what you can see is that that peak of inflation that we all were worried about is behind us. And when we look over the next couple of months, inflation is going to be very well behaved. So we've debunked the first one. How about fiscal? Now, Trump is coming in only 2 days. Some of the policies that he's going to introduce could be very negative for the fiscal picture. And especially if you're a bond investor, this could concern you. Now, what I'm here to tell you is that when it comes to the fiscal piece as well, the US asset will always have the allure. It always has that gold property, right? It's a safe haven asset. So the attractiveness when it comes to US assets will stay. Now, borders and geopolitics, B. Now, unfortunately, in the last couple of years, we've met a series of unfortunate events. We've had the trade war in 2017, 2018. We had actual physical wars in Europe, in the Middle East as well. However, if I just ask you to shift your lens away from what we see again in the news, to really look at what's really happening and how we have navigated through that. As you can see right in front of you, that red line that you can see is China's exports to the US. So as you expect, when tariff hit, China stopped or at least lessened the exports to the US. But the rest of the world's export to the US picked up. So we have been through this movie once already. We've seen this play out, where we have shifted supply chains as well as to really accommodate what's happening. Now, next one, unemployment and recession. 2 words that when you read, it causes that sort of concern, right? Again, negativity bias. Now, obviously, when it comes to unemployment, all of us here, myself included, that's a word that scares me, just because you want to know where your next paycheck is going. We have children, we have commitments, we have house to pay for, etc. But again, if you just look in front of you, this is the US unemployment rate, right? Focus on the blue line. unemployment in the US now is at historical lows. And last week, we had an unemployment report out of the US, and it even fell against expectations. So what I'm here to tell you is that really, when you hear all the news, we have to kind of shift our lens to really focus on the underlying data. Now, the final piece, though, trade and industrial policy. This is where we think could affect us a little bit more, especially for me as a macro strategist. Because if we take what Trump is saying, right, which is 10% or 20% universal tariff and additional 60% on China, that's very scary. And we've kind of mapped out how this looks like on US tariff rate right here. So if you just look, and we're going back all the way to the 1930s, if you look at 2017, 2018, when he imposed the tariff, yes, it increased, but not so much. What he is talking about now, the idea that he's floating, you're seeing tariff rate climbing a lot higher. But here's the thing, right? You've heard about FTAs, free trade agreement. You heard about the NAFTA, etc. It's not so easy for Trump to come in and just impose the tariffs as well. Tariffs, at the end of the day, is a negotiation tool. So what this means is that the actual tariff rate that we could see will be somewhere where we are now to the extreme case. But again, we always consider the extreme case scenario, and that's what you're reading in the news, etc. So again, it is a negotiating tool. Now, let's clear the fog. The sun has risen, things are starting to grow. How is the US economy beyond all the noise, right? We've confronted our fear. So what's next? The US economy is in good shape, put it very simply. So over here are two indicators that we look at, and we can look at a bunch, right? Over here, what I've done is just focusing on two. On the left is the light vehicle sales. So if you buy a van, you buy a car, that's exactly what's going to be fed through on that blue line on the left. And the chart on the right is business fixed investment. What this is capital spending. So what US companies are buying. So are they buying machines, etc., right? Are they buying new factories? And why do we care about whether they buy factories? Because if they start buying factories and machines, it means that they think that the business outlook is going to be positive. Then they won't fire people. Now, if they stop spending, the next thing is going to happen is that they're going to stop hiring people, and then they might start firing people. So over here, what we've done for the benefit of everyone here is that we've put this black horizontal line through both charts, and that is the historical average. Meaning, if my blue line is above that black, where we are right now is still relatively positive, and I'm happy to report that we are in a very positive state when it comes to the US. So what this means is that in the next 6-9 months, things are going well. But we're all long-term investors, right? We're not in and out of the market. We want to know what's going to happen 3-4 years now. So what is going to sustain the US economy in the medium term? AI. I'm sure you've heard AI being spoken about a couple of times already this morning. But this chart on the left is very, very interesting, right? So these are spending, so capital spending by hyperscalers. And all of you will know what hyperscalers they are talking about. These are the largest companies. And what you can see in that shaded gray-black bar there is that in the next couple of years, the amount of spending that some of these hyperscalers are committing to is close to $1 trillion. We have not seen anything like this before. And going back all the way to 2004, nothing of this sort. So as long as these tech companies are spending and spending and spending, that's going to keep the US economy chugging along, at least in the medium term as well. So great, right? So cyclical terms, we're good. Structural terms, we've identified a trend that's going to keep the US economy going. So what have we done so far? We have faced our fears on the uncertainty. We have established that the US economy is doing well. So what do I do with US equities? Obviously, you've heard US equities are expensive, it's at an all-time high, etc. And people tend to stay on the sidelines when they hear such things. What we are here to tell you is that look beyond the peaks, because for every peak, you're going to see another peak. You just can't see it yet. So on this chart, it's a very good demonstration of that. So the gray bars is if you invest on any day, the returns you're going to get from S&P 500, any day of the calendar year. The green bars is the returns you're going to get if you invest on the day that the S&P 500 reaches an all-time high. Do you see that much difference between the two? No. So here I'm debunking another of that, what you might hear, which is US equities reach an all-time high is too expensive. Let me just stay away and wait for a market correction and then get in. Because it doesn't make much of a difference. And over the longer term, the returns that you might get from investing on a day that the S&P 500 gets an all-time high, for example, if you stay invested in over a 5-year horizon, you might get even higher returns as well. So 2 messages here: invest. Number 2, stay invested. So what is that trend that we've spoken about, the AI? How is it playing out? You've heard so much about the top 10 stocks, the Magnificent 7, and that's for good reason. If you look in the middle of this chart, that green bars, those are the earnings growth of your 7 mega caps, right? Which is why it's dominated all the conversations every time you talk about US equities. Again, I care about the future, right? The past is the past. I'm a long-term investor. What's going to happen next? Now, if you look at the right side of the chart, and those are 2025 earnings growth, the green one, your mega cap, your blue is any other stocks in the S&P 500. You see a catch-up. The blue bar is actually starting to expand and playing catch-up to the green one. Why? Because every other sector, even beyond the infotech right now, they are committing to adopt AI. And when you adopt AI, you're going to improve productivity. You've seen some malls in Singapore, you look at the drop-off point. Sometimes you don't even see security guards anymore. You're seeing this robot thing, which, no, obviously it gets in your way sometimes, but you don't even see a security guard anymore. You're seeing this man with that robot thing with the camera right there, and that is AI. So we are going to see that broadening trend as well. So what I'm here to tell you is that not just focus on the hyperscalers, but really look beyond that US spectrum as well. Now, is it just about that? What about quality? And we hear quality, quality. Let's just conceptualize what quality means. On this chart over here, that green line is the returns of the segment of quality stocks in the S&P 500. So these are stocks with very good returns on equities versus the broader S&P 500. So if it does well, it means that my quality stocks are outperforming my broader index. So remember, I was so constructive earlier, right? I said, look, US equities, US economy is going to do well, but what if I'm wrong? Because we all don't want to fall into the trap of being complacent. We don't know what Trump is going to do in 2 days, what he's going to tweet. So what I'm saying over here is that the range of outcome is so much broader now that you want to think about what's going to happen on a rainy day. And what has happened on a rainy day, if you look at the gray bars, those are periods of recession. You have the 07, 08, you have COVID. And what's happened during those periods? Quality stocks tend to outperform the broader index. So again, you stay invested, but that focus on quality is going to be so important as well. So staying very active, identifying those trends are going to be very important also. So my final section, we've spoken so much about US equities. Are there opportunities outside? Should we forget? Nope. What we're saying here is think global, invest globally as well. And obviously, like investing, when you go out to a supermarket, when you buy anything, you gravitate to the cheapest, right? That's what I do at least. And if you look on this line over here, this is the valuation of international equities versus US equities. So if the line goes down, it means that international equities is getting cheaper than US equities. Look where we are now. We have 2 decades worth of data. Right now, international equities is at a cheap level compared to the US equities. Let me put it differently. Statistically speaking, this only happens 5% of the time. So now, it's cheap everything though. If you go to, for example, Best Denki, you go to Courts, you need to buy a new rice cooker. You go to the cheapest. But it's not all about the price, right? You need to think about the quality as well. Is it going to consume so much electricity that at the end of the day, it's going to cost me so much more for buying the cheapest? So let's think about what is going to drive equities going forward. It's going to be earnings growth. So if you look at the earnings growth of every other region besides the US, which is the second bucket, and just focus on the blue bar, which is 2025 earning growth potential. You're talking about Asia ex-Japan 14%, Japan 9%, Eurozone 10%. These are still very constructive earning growth numbers outside of the US. But again, the need to stay active, quality, and really identifying trends is going to be very, very key to investing globally as well. So to kind of wrap up my section before I hand it over to my colleague, again, we hear all this noise all around about headlines, but let's cut through the noise right now. The macro fundamentals for the US economy has not shifted. Stay invested right now. Keep investing, especially when it comes to US equities, focus on quality also. And finally, not only focusing on the US equities, but really thinking globally, invest globally, but being very mindful of the opportunity of being very active. And with that, I'll hand over to my colleague Daryl, who will take you into some of our key strategies.